Hello everyone. Welcome back to the Mergers and Acquisitions Institute. My name is Sam and today we will begin to understand mergers and acquisitions. First, let's look at the contents of today's subject. And here are the learning objectives. Write these down so that we can refer to them later on in the video. Let's first develop our understanding of what mergers and acquisitions are. Mergers and acquisitions both begin with one company acquiring shares or assets of another company. Then, the two companies will either merge or remain separate entities depending on the stakes held, the business strategy, or the nature of the two companies. The acquiring company is said to be on the buy side of the process, while the acquired company is said to be on the sell side. Companies conduct M&A activities for their business growth and target companies for profit realization. Mergers and acquisitions each have different transaction structures. In a merger, there are two or more separate companies at the outset. Once a merger is concluded, the survivor company or a newly created company will have absorbed all obligations, assets, and liabilities of all companies that are party to the merger. In an acquisition, the acquirer takes ownership of a target company. Then, the target company will remain a going concern in its existing form as a business, as will the acquirer. The two companies remain separate legal entities, and the larger establishment who has acquired the other is known as the parent company. The other is known as the subsidiary. It is only the ownership that will change. So when it comes to two or more companies coming together, it is about the methods and financial statements that are required that determine whether the process is to be a merger or an acquisition. M&A also involves any form of business combination or collaboration that impacts a company's management or structure. Here is a list of M&A transactions that can occur. Divestitures is the process of selling off the subsidiary's interests or investments. This method is often used when a company wants to separate an asset or business division from its overall company. In a split-off, the parent company offers shareholders the option to keep their current shares or exchange them for shares of the divested company. While it is a rare occurrence, the divestment strategy could maximize shareholder value by offering a new potentially higher growth company for investors to hold shares in. Spin-offs involve converting a pre-existing company or public division into a wholly owned subsidiary or distributing the stocks in the subsidiary to all shareholders in the original company on a pro rata basis. New spin-off companies can generate even more value for shareholders as they will solely focus on their own product or service line. They will also have more control over their resources, finances, and business strategy. A carve-out is to sell some or all the shares of a subsidiary company in the capital markets, usually through an initial public offering or an IPO. This can help generate investor funds and allows part of the company to operate independently. It is fairly similar to a spin-off, except instead of giving shares to existing shareholders, the carved-out entity will have its shares sold to new investors. To make a carve-out tax-free, only 20% of the subsidiary stock can be offered to the public. Business collaboration is when one company enters a contract with another company for a specific period to utilize and share resources to create or improve their goods or services. The majority of the time, this is much easier, cheaper, and less time-consuming than engaging in a full merger or acquisition. There can be various components of joint ventures and strategic alliances, including knowledge transfer. A joint venture occurs when two or more counterparties agree to carry out some form of collaborative project together. They each enter a shareholder agreement, usually create a brand new entity in which to further their business operations and consequently share the profits or losses from the new project. A joint venture does not have to be a 50-50 split. When it isn't, the party with the highest stake generally has the most control over the project. Strategic alliances are the process in which companies get into agreements to combine resources and knowledge. They aim to achieve new products, services, or other key business goals through collaborative R&D. Knowledge transfer is sharing knowledge about a topic or subject. Participating companies aim to generate new developments and research in a specific sector, leading to new inventions, production methods, and novel material uses. So why do companies become involved in M&A transactions? Well, they actually do so for various reasons. We can divide these reasons into two overall categories. The first is because they are trying to strengthen the company's market dominance. The acquirer or parent becomes a larger organization, gaining increased market share, market dominance, and brand value in its industry via acquisitions. The other reason is to diversify a company's portfolio of products so that the acquirer is less dependent on segments experiencing declining sales. This motive mainly stems from companies experiencing a slowdown in sales in their core businesses. A company can often take a long time to come to fruition in terms of its success. Acquiring a company with new products, technologies, or businesses, or entering into a collaborative partnership is much more efficient and progressive. Here are the top 3 M&A deals in history. The biggest deal in history was Vodafone's acquisition of Mannesmann for $203 billion in 1999. Vodafone was a UK mobile service provider, and Mannesmann was a German-owned industrial conglomerate. After acquiring the target, Vodafone became the world's largest mobile operator. The next was the $182 billion acquisition of Suez by Guest France in 2007. This deal is one of the largest energy sector mergers. The combined company has made a diverse and flexible energy supply stream with a high-performance electricity production base. AOL bought Time Warner for $182 billion in 2000. AOL Business was an American web portal service, and Time Warner was a media company. This was a collaboration between the world's largest media conglomerate and the world's largest internet provider. Thank you so much for watching this video, guys, and I'll see you next time. Bye.